Hey, this is Brant from Wolf on Wall Street Trade with a market update for the week ending March 15th, 2019. Wow, what an incredible week. There's just so much to cover that there's no way I'm going to get to all of it. For members on the site, I would suggest going through the daily wraps. There's just so much information this week that reveals a lot of the tone and character of the market. And it was an interesting week because it's quad witching, or triple witching actually. We just call it quad witching in the biz. Historically, these are very strong weeks coming into the week. Coming out of the week, they tend to be weak. This is a daily chart of the S&P 500. This area up here is a resistance level that a lot of people are looking at. I have it labeled as 2816.94. It comes off what people see, or what technicians see, as a triple top here, or quadruple top they're calling it now. There's just no such thing, but it is an area of interest. It's an area of potential resistance. We came to this pivot low that I mentioned in last weekend's video here around the 5th, the 6th. So last week we had this kind of uglyish pullback sell-off. The tone in here was uglier. And this week, I'll take off these trend lines. You can see the S&P actually made a slightly higher high, or if we look at a weekly chart, and I'll zoom it in. So here is that previous week, kind of ugly bearish engulfing candle engulfing this, made a slightly higher high here. So let's back up a little bit where we left off with the last video. And this is a 15-minute chart of the S&P 500. So this is Monday, February 25th. This is Monday, March 4th. These were both gap up and selling on trade optimism. So they gapped up on trade optimism, sold down. And this is what we covered in the last video. We went from kind of a small bear flag here to a larger bear flag. Then on the decline, these smaller bear flags, it did not meet the measured move target. It hit this level that looked like support. This is back at that February 5th, February 6th pivot low. And it looked like we were ready to bounce or see some kind of correction from there. Now, I kind of mentioned it in the last video for members. I had been talking about it most of the week. Jerome Powell, the head of the Fed, Bernanke, and Janet Yellen on 60 Minutes, and I thought that could be a market-moving event. This was Monday, so 60 Minutes was Sunday. I watched it. There was really nothing new, but the market just, it hated Powell in Q4 2018. It loves Powell now. This is just an enormous day on Monday. Pure momentum on the upside. Now, whether that's related to Powell, whether that's related to the options expiration, whether it's related to buybacks before the buyback window closes in the next week or so, it doesn't really matter. The point is, it just blew higher here. And if we look at it on a daily chart, this is Monday. So this is the strongest day for the S&P and NASDAQ, by the way, since January 30th, which is right over here. This was the FOMC day where the Fed went even more dovish, and it's the second strongest day since January 4th right here. This is when Bernanke, Powell, and Yellen all appeared together. That's the first time Powell went dovish. Okay, so here we are back at the daily chart of the S&P 500, and no trend lines or anything. So a couple salient points to take away from this last week. So here's where the market is starting to get wobbly, February 25th. Here is the March 3rd wobbliness and that sell-off that last week, and then here is a slightly higher high. And what I want you to focus on is this kind of area, like this 25th, 4th. Just imagine, I'm not going to draw in trend lines because I don't want to clutter the chart, but we have a slightly higher high here in the S&P 500. You won't see it in the SPY because of ex-dividend. You've got a higher high in the NASDAQ here. And something I want to point out real quick, if you look at QQQE, which is an equal weight version of QQQ, you can see it didn't make that higher high. That's the FANG weighting in the NASDAQ 100, those FANG stocks, or the large cap tech stocks that have a lot of weight that push around the NASDAQ. That's why the NASDAQ made a higher high. The Dow Jones Industrial, I'm not going to pick on these because Boeing got creamed last week, but you can see relative to these two highs, it did not make a higher high, and Boeing, they've had a lot of trouble. So I think this was down like 11% on the week. But the most important one is IWM small cap. So again, imagine that trend line up here connecting the 25th and March 4th. They were up on the week, but they were just up strong on Monday, did nothing the rest of the week, and put in this little shooting star on Friday. So this is the thing I'm always watching. People are always watching the FANGs and they're interested in those. I'm looking at the front end cyclicals. I'm looking at the big indexes that have a lot of stocks. You have massive underperformance in the small caps last week. And another way to visualize that is to take the S&P 500. So here's the S&P in the red and green candlesticks. This is small caps or IWM's relative strength to the S&P 500. How are small caps performing versus the benchmark index? So you can see early in the rally, performing well, right? And performing well here after the Fed. When we got into last week's weakness, or the prior week, you can see not performing well. You can see them pick up on Monday a little bit and collapse through the rest of the week. Now, why is this important? Let me go back and give you some perspective. Here you get some more perspective. So this is their early January 2018 rally. You can see small caps. Now they did rally. If you look at small caps, they rallied, but relative to the S&P 500, they were showing weakness here. That was a warning sign here. They rallied big time over here into April, May of 2018. This was that trade that small caps are a safe haven from trade wars. And then you could see they started to really come apart into September. And if we kind of just back up and look at this more closely, I'll walk this forward. So this is that time when the S&P and NASDAQ were back testing their uptrend channels. And just watch what this white line does relative to the S&P. You see it just tumbling here, and that's right before that sell-off started in October. And if I just walk this forward, you'll see them weak here as well, right when the market pivoted to that second leg sell-off in late December. There's the sell-off in late December. Here's that early strength in the rally. And this is what we end up looking like on the whole. So you can see relative weakness here, relative weakness here, relative strength here, early relative strength here. And last week, even though IWM was up and it rallied, relative weakness here. Also relative weakness in the Dow transports versus the Dow industrials. That's what I just changed this white line to. Again, S&P 500, relative weakness here, relative weakness here. Last week, a lot of relative weakness as the market sold off. And this week just didn't get very, much traction at all. Here's kind of a little update of those last few charts I posted in last weekend's video. Here's the S&P 500. I'm going to jump to an intraday chart. So this is a 15-minute chart. This is that trend weakness in that channel the prior week. Here's Monday, absolute momentum, and the S&P consolidating a little bit into the end of the week and breaking out. And this is kind of what I thought was probably going to happen because so many people are watching this potential resistance level. It's just an easy stop run. So let's look at small caps on the same chart. And here was the larger channel. Remember, they sold off more that prior week. So here's their rally. This is kind of where I expected them to be, somewhere in this channel, or maybe up at the top. Didn't quite get the same kind of momentum that the S&P did. So whenever small caps are lagging, that's just a warning sign that something is not right in the market. You've got 2,000 stocks in this index versus 30 in the Dow, 100 in the NASDAQ 100, and 500 in the S&P. Here's a little different view. This is the IWM's uptrend. We saw that big bear flag. Remember, it broke down, kind of consolidated on the trend and broke down that prior week. This is last week, Monday. Almost all S&P sectors, 11 sectors, were up between 1% and generally about 2% on the week. Technology by far was the leader, up 4.5%, and the only sector that actually closed down was industrials, and that's because of Boeing. It's got a very, very heavy weighting in the Dow 30. It's the most heavily weighted stock. It pushes the Dow 30. So what I was saying last week was just watch how the trade evolves, because a bounce, a rally, you know, that was kind of to be expected as we came down to this pivot point and started losing downside momentum. Really sensitive sectors that have been problematic recently look to me like they're forming bear flags this last week as they rallied. Probably most notably, especially for the small caps, is the regional banks. You go to KRE. So this is the last week's rally. That looks a whole lot like a bear flag that's starting to break down, and that has a downside target of about 52.50. So the measured move from here, downside target. Another sector was industrials, and like I said, I'm not going to pick on the Dow and industrials too much because of Boeing, and who knows how all that's going to resolve. But again, another bear flag, started to break down below at the end of the week, and that's got a downside target of about 72.25. So on a week where the S&P 500 outperforms, like we see here, again, still 15-minute chart, and small caps underperform, you can almost be assured that there's going to be breadth issues, market breadth issues. And for members, you know I've covered this all week, watching what was going on with market breadth. So I'll show you a couple quick takeaways. This is the S&P 500 from the rally at the start of the year. So this is the entire rally. This little white line is the percentage of NYSE stocks that are above their 40-day moving average. So typically what you want to see is that these move up, breadth indicators move up with the market. This is where they start diverging. So I have this little blue, light blue trend line. That's roughly that S&P 2817 level. There's February 25th, March 4th, and this past week just poking above it and closing above it. So if you look at the percentage of NYSE stocks that are above their 40-day moving average, they've been rising here, even leading at certain parts, leading the market. So like in here, they're leading the market higher. Over here, you see they're making lower highs, and really kind of collapse over here in that week that the market was down pretty good. And here's the rally last week. So the main takeaway is, one, breadth is not improving. You have fewer stocks participating now. That's market internals, market breadth. So you can see this large negative divergence in breadth versus what the S&P is doing over here. And even on the week, if you take like a close look, you know, first pokes through on Wednesday, kind of backs down, and here's that quad witching options expiration on Friday, and it actually makes a lower high. 52-week new lows on the NYSE increase the last 2 days. So you have the S&P potentially breaking out of resistance as far as technical traders go, and you have 52-week new lows actually increasing on that. That's not a good sign. And that's coming on the heels of retail and institutional investors capitulating. And we've talked about this a little, I think, in the last video. So we had something like 12 consecutive weeks of outflow. The mom and pop investors didn't want to buy this rally. Then they started to kind of trickle back in. The EPFR data that Bank of America compiles says that last week was the biggest, or the second biggest inflow ever in history, is something like $27 billion. So what that tells us is that the fear of missing out trade is now running rampant. People are getting confidence now that the market's been up for, you know, almost 3 months, and they're coming in as market breadth and internals are starting to deteriorate. Here's NYSE 52-week highs in yellow here, and the S&P up here. And this is that area we're talking about where breadth started to deteriorate. You can see fewer new highs being made as the market is, well, the S&P made a new high on Friday, right? And if we look at 3C here in orange on the SPY over this entire rally, here's the December low. You can see over here good strength, you know, good confirmation of the early move, and again over here after the Fed. And you can see almost the same thing as like what breadth is doing. So this is a money flow indicator, and it's showing lower highs over here. Really kind of deteriorated this week in this bear flag here and came down. I expect to see it come down. You can see the negative divergence here. I expect to see it come down when prices are coming down. Some strength on Monday right here, and then through the rest of the week. Look at this. So it's now starting to make a leading negative low over here, and what looks even worse than the SPY is small caps. So again, here is the rally off December 24th low. You can see strong confirmation in here, leading positive up here, some deterioration in here, and then we get into that Fed kind of dovish pivot rally, a new trend line here. This is that week of weakness, the bear flag. Here's the trend line broken, and you can see leading negative into this bear flag and confirming on the way down. This is Monday, so some good strength on Monday. The rest of the week, look at this. So my gut feeling is that some technical traders are getting squeezed here. You got the options expiration, quad witching. I'm not sure how much I'm going to read into all of last week's action because of that. But you do see that you have that technical level, and we do see retail money pouring back in. And I think there's a pretty good chance that this is setting up a bull trap to catch those retail traders or investors who didn't want to participate here and now have confidence because the market's been up so long. But the most interesting development, this is what I was saying at the end of last week's video, to pay very close attention to is what the Treasury market's doing versus the stock market. And that was probably the most insightful development last week. Here's the 10-year yield. This is that trend line I was talking about. Pay attention if the market, this is how I ended the last video, if the market is up and you see yields, the 10-year yield starting to fall, that is a major warning sign. So this is that trend line of support that they've been holding through the rally, and that is what they did. They came down and they fell last week. On a weekly chart, the 10-year yield had the lowest close since January of 2018. Again, here's our rally. And here's the 10-year yield overlaid on this rally. So this divergence here started, but it held this level here at about 2.62 or 2.625% for the 10-year yield. This is what I was warning about last week. I expected to see yields come down. That means people are moving into treasuries as stocks sell off. I expected to see that. What I didn't, well, actually I kind of was suspicious. That's why I warned about it last week, was watch this trend line, watch this support. If stocks rally and yields fall, that means bonds rallied as well. That is a major warning sign. We have a new weekly low close in the 10-year yield, leading the S&P lower. This is the bond market telling you we see major problems with growth. Oh, and speaking of which, before I move on, for members, subscribers watching this video, if you did not see my TLT update on Friday afternoon, please go read that update. I think this is one of the strongest trades positions setting up if you get it right. I think you can have probably something close to a 10-to-1 risk reward or reward over risk. And it has big implications for the broader market as well. So what happens into next week? I don't have a lot of conviction because of the FOMC on Wednesday. 3 strongest days in the S&P and NASDAQ. Here, Monday on the 11th, the day after Powell, Yellen, Bernanke appear on 60 Minutes. Over here, the FOMC at the end of January. And over here, the what I like to call the Grateful Fed, the reunion of Powell, Bernanke, and Yellen appearing talking. This is the first time he went dovish, and the market loved that. So we're having a FOMC meeting Wednesday. Expect to see volatility get crushed in the day or two before that, and then after that it could soar. There's one thing I'm looking into next week is buying some volatility. I don't want to do it right before that FOMC meeting though. Now briefly, I'm going to do a video on this and cover this whole concept in much greater detail. What do I think is actually happening here? Like I've said, we've got a really vicious sell-off, okay? And so far, we still have a counter trend rally. This is your sell-off. Now, we're coming above this little resistance zone that traders are all focused on. That doesn't mean a lot to me. You can run that in the afternoon. What I'm starting to lean toward is this being a massive top taking shape. If you want to kind of visualize it, I would say something, along these lines, where December was kind of an outlier on the downside. That might be a big head and shoulders top. The left shoulder here, the head here, the right shoulder here. The indicators, the market breadth, the deterioration in here where you'd expect to see it at the head was there. It was much stronger deterioration than what we saw over here. That's kind of how head and shoulders develops. Or, it may look like something like this. Who knows? But this is kind of what I'm viewing, and I think we have a pretty good probability that we're going to see the market come down at least to here. And if it does, then we'll kind of be able to look at those breadth indicators. We'll be able to look at the new lows, see how they're acting relative to other areas. Big, massive rallies tend to form big, massive tops. So let me put this on a weekly chart. So this is the 2000 tech bubble for the S&P 500. Looks different for NASDAQ, of course. This is the 2007, 2008. These are somewhat arbitrarily drawn trend lines, but the kind of point I'm trying to get across is when you have a big, massive rally, you don't get a 1 month or a 2 month top. You get a big top. This was a huge bull market, but I'm going to do my due diligence before I do this video on this potentially being a head and shoulders top or some other kind of form of top. Look at the volatility in this. And when I get that all together, I'll put it out. And we'll pick it up next week on Monday.